Hello, you Alabama Roll Tiders. How are y'all? Hope everybody's having a wonderful Wednesday and just a great, great day in the world. And so today I want to go into one of my smaller accounts. Let's see, where is my smaller accounts that has like $7,000 in it? Let's see, where is it? Let me see if I can find it here, y'all. Just one second. Option buying power, stop buying power. It's this account right here. Yeah. So let's click to trade this. So we've got $7,000 in this account. You see that overall we have made $63,000 on all the accounts that are in this tasty trade. 47,000 there, 14,000 there, $1,600 there. To add them together, it's made $63,000. So these accounts are performing very, very well. And so what I wanted to do in this little account is, you've got a smaller account and we're taking some big risk in these other accounts. So let's say you didn't want to take anything that was really risky, but that you wanted to do something that would get you the equivalent returns of buying T-bills. So I just wanted to show you, first of all, let's buy some treasury bills. And let's go into one of my accounts here. Let me pull up a spreadsheet because I have it. Let's go into the Roth IRA or just the regular IRA. Let's do that. Let me pull up my regular IRA. So we're going to go over my trade plan today. But part of my trade plan is that I can buy treasury bills. Now, treasury bills, a lot of times, ladies and gentlemen, are really good because you can make, up until a couple of years ago, they were 0%. You could make nothing on them. But now these boogers are paying like 5%. Now, when the Fed does finally decrease interest rates, those will go down some, no doubt. But right now, they're really, really good. And what I like is I have a T-bill thing here that says, hey, if I've got $72,000 in my account, I can put up to 50% of my capital into T-bills. And so it tells me my quantity to buy is 7. So this is an account where I trade options, and it says I could buy 7 weekly. All right. So let's go and log into my TD Ameritrade account and just show you what it looks like to be able to trade T-bills. So I log into, now make sure your broker, you can do T-bills, right? And I'll just show you how to buy T-bill. A lot of you said T-bills. I've never done that. Oh God, I just got the Schwab darn thing now. I may not can do it now. Let's see. Schwab, log in Schwab International, Schwab. Oh, geez. Portfolio management. I guess this is what I'm logging into. Let's see. Here we go. Bobby Beth 203. I guess this is it. So I was going to show you something that I may now not be able to do. Text me at my number. Let's see, get a security code here. Send me my darn code for the love of the Lord. No, okay, here we go. So my code is all right. Trust this device. So we may learn something together today. I don't know if we can do it on Schwab. All right. So log into Schwab. Well, I thought I did. The system is temporary, unavailable. Risky move to get started and complete your Schwab. Oh, you got to be kidding. Login ID and password first. Okay, who's it for? What's it needed? Yeah, I hate this that they've done this. So I won't do the actual buying of T-bills, but know that you can log into your brokers and buy T-bills. They're in minimum of $1,000 that you can do that. So what I'm going to do instead is I'm going to go into this account and we're going to buy something called Bill. And let me show you what Bill is. Anybody familiar with Bill? It's an ETF, and I'll just get the little thing here. It's the Spider 1 to 3 month T-bill. Let's see. Spider Bloomberg 1 to 2 month T-bill. Let's see if we can see what it says about it. Here we go. So what it does is it's been paying a dividend, and it'll give you about 5% over a year, and it's an ETF that holds 1 to 3 month T-bills, which is really kind of cool. Let's see if it tells us anything here. So it's trading about $91.49. It's very stable. And what you do is it pays that dividend, yeah, 1 year return bill, 5.17%. So it's paying right over 5% a year, which is about what T-bills are paying. So what we do is go into this thing and say, let's type in bill. And so I want to buy some. So you're going to go out on the bid or the ask? Does anybody know? Jason, do you buy on the bid or the ask?
I was trying to get off double mute. I think it's the bid if you're buying.
If you're
No, I'm sorry, on
buying,
the ask.
it's the ask. In other words, which one's going to screw me more? If I paid $91.48, that would be good. If I had to pay $91.49, that's bad. So you think whichever one is worse off, right? Now, if I was selling it, they would sell on the bid and I buy on the ask. So I'm going to buy on the ask. So let's see this, see how many we can actually buy. So if we buy 100 shares of this, it looks like buying power that it would take to do that is $4,574. Well, my option buying power, and I don't want to use stop buying power because that would mean that I would be buying on margin and they would charge me margin interest, and the margin interest would eat up anything that I would make on the thing. Okay, Kristen's having audio problems, so she's going to close Zoom and re-enter. Can you hear now, Kristen?
Yes, I'm back. Thank you.
Good. All right. Hope your day's going well. So let's buy 100 shares and just see what it does to us. Okay. So it should take $4,500 of our buying power away. So let's just buy 100 shares here and swing. We are in. And you see now it brings us down to $2,400 in buying power. So let's try to buy some more bill, right? I'm trying to use up almost 100% of my buying power. Says I'm at 32 there. So let's see if we could buy maybe 40 or 50 shares. So let's go on the ask again. And let's see what happens if we do about 40 or 50 shares. 50 shares would be 2287. We have 2436. So let's fire off for another 50 of those. Yep. And so then that brings my option buying power down to 149, which is kind of cool, right? So yeah, I think that's as many shares as I would get for now. And the cool thing is, let's see, that's going to make it. Let's see, where's my little pen? So if we have 150 shares and it's paying right now a 42-cent dividend, what's that? 2 times 0, 4 times 0, 20, $60, right? That right? So about $60 or so in dividends. That's really good. I like that. Did I do that right? I think that's right. Not good at multiplication. Not good at math in general, actually. All right, any questions on buying bill? I was going to show you how to buy treasury bills too, but just check with your broker, make sure you can do it. It's very safe. I like buying treasury bills. Normally I'll buy 1 month and 8-week treasury bill, 4-week treasury bills, 8-week treasury bills, and it's kind of cool. So there's bill. It's a substitute for me actually trading in the treasury bills. Oh yeah, we're up 75 cents now. We just bought them. Praise the Lord. Look at this. This is great. All right. So what I wanted to do is to go over my trading strategy and just show you my trading strategy, my trading plan. Now, I do a lot of mentorships of people all over the world, all the way from Luxembourg to Australia to Great Britain. And I tell everybody before you become a trader, make sure you have a written trading plan. My trading plan was last updated on February the 24th. And we're just going to go through some of the highlights of my plan today, just show you what it is. We'll do this for about the next 20 minutes. We'll keep you about 30 minutes today. So my trading plan strives to quantitatively, I'm a quant trader, extract profits from financial markets utilizing S&P 500, SPX, S&P 500, SPY, mini SPX options, micro E-mini S&P 500 index, and E-mini S&P 500 index funds. All of these are S&P 500 contracts. They are just different. Like, the SPX is twice as big as the E-mini futures. The SPY is 1/10 the size of SPX, and so on and so on. The mini SPX is 1/10 the size of SPX. The E-mini micro E-minis are 1/10 the size of the E-mini futures. So these are things you'll always learn. But I'll just trade S&P 500. Now you could do this on stocks even, but I just like the S&P 500. I just trade one strategy. I trade one thing, one product, and it just kind of keeps me keeps me sane. So this trading strategy is composed of two primary components: a naked put and a put debit spread, and I will explain what those are in just a little bit. Now, there are three things that I do to keep my portfolio going here. And let's see if I can get the review, the design, the layout. Where's the draw? Here we go, draw. So we can draw here and just show you everything. Okay, good. So what we do is three portfolio metrics control my entire portfolio. And the first is delta. And delta represents the directional risk of your portfolio. If you have a positive delta, you are bullish. If you have negative delta, you are bearish. Bullish means you want the market to go up. Bearish means you want the market to go down. You've probably heard the bulls and the bears. For example, Chicago has the Chicago Bulls, which is the basketball team, which means they're intending for the ball to go up. And then they have the Bears, Chicago Bears. Bears means down. And if you watch the Bears, they're one of the down teams in football right now. Hadn't been really good since the 80s. So delta is our directional risk. And what I refer to as delta is, if you'll think about your car, you have a speedometer, right? That tells you how fast you're going. Am I going 55 or am I going 60 or am I going 80? Your speedometer. Your delta tells you how directionally long or short that you are. So let me just show you that here. On this account, let's do this account. Hold on. Let's go to this account here. Take this off. Show you this. Okay, so this account has SPY-weighted deltas of 345. That means that this account has the equivalent of 345 shares of SPY. Now, this portfolio has 0 SPY in it. Look at our positions here. Our positions are made up entirely of bill and the E-mini futures. So what beta weighting does is it says it converts everything that you've got as far as bill, E-minis. If you had NVIDIA, it would take all of that and it would convert that into SPY shares to give you your delta equivalent, your SPY weighted deltas. SPY deltas. SPY is the S&P 500. And it says, effectively, I have 344 shares of SPY in my account, even though I have no SPY. It's an approximation of your direction. So this is a bullish account. I profit when the market goes up, not when the market goes down. And you can see just today, this account has made $1,069. This account just today, y'all, has made $6,200. So we've made $7,400 in all of our accounts together here. And this is just one of my brokerages, right? So that's your directional risk. It is your speedometer. Questions on delta. And you want it SPY weighted. So in your platform, Thinkorswim, with the paper money, you want to make sure that you have this beta weighting checked and you have your SPY beta weighted. If not, your your deltas are going to be wrong. Watch, when I uncheck that, watch, my deltas go to 15.22 deltas. Well, that's not correct. We want to keep everything the same. It's 152 deltas, which means I have the equivalent of 152 shares of SPY. That's your speedometer. Now let's go to our next gauge, and it is theta. Theta is the fuel upon which your portfolio runs. A primary goal is always to maintain a minimum theta of 0.001 times the portfolio's net liquidation value. What is net liquidation value? We call it net liq for short, and it's just the amount of your total balance of your account. How much money do you have in your account? So theta represents the fuel gauge. And with theta, you don't want to overfill it. You want it to just be just enough. So this is empty and full, right? And you want to be just right, kind of where in the middle. You don't want to be too full and you don't want to be too empty, running on fumes. This is what happens. Theta is the amount of money I am expected to make in my account every day. It is the amount that the options that I sell, it is how much they decay per day. So let's look at that. If this account has 360 theta, there's my theta, that means that theoretically I should be making $360 today, a day. But theta decay is not linear. It's not linear. It's not 360 today, 360 tomorrow. It may be 520 today, 180 tomorrow, 480 the next day. Okay, so theta is not linear, but it is the decay of the option. When price goes my favor, I get more theta decay. So I've actually made, 3 times almost the amount that I should be making today. I made 1,080 in this account when I should be making 360. It is the fuel in your car. And you want to make sure in your options portfolio that you maintain a theta of at least 0.10% of your net liq. Well, what does that mean? Well, if I have $100,000 in my account and I multiply it by 0.001, that gets me $100. So in a $100,000 account, I would want to maintain a minimum of $100 of theta. This account is a $300 and something thousand account. So I should have $359. That's probably right where I need to be. Okay. So there. Now there's maximum theta too that I don't want to go over, and it depends on volatility. Now, ladies and gentlemen, volatility means opportunity. When you hear the word volatility, you should instantly think volatility equals opportunity. When the market crashes, that is our opportunity for you to get in, right? Volatility is measured by an underlying that we call VIX, and you can actually see VIX. Now, VIX is the fear index, and let me show you the fear index so everybody can see this. VIX, VIX, you can actually type it in. VIX is at 14. VIX historically is at 17. That's his historical average, around 17 to 18. So with VIX being at 14, that tells you that there is no fear in this market. This is based on the 30-day options of SPX, the S&P 500. That's what VIX is based off of. And with VIX being down today, normally when the market goes up, VIX goes down because there's no fear. Yesterday, when the market was down big, the VIX went up. And you can actually chart VIX and see what VIX is doing. You see this? VIX goes up, people get scared, then they get complacent. They get scared, then they get complacent. Then they get scared, then they get complacent. And as you can see now, we are at the lows almost. This is through June of 2015. Look at there. We are right at those lows now. Nobody is scared. Remember when what Warren Buffett said? He says, when people are fearful, that's when you and I need to be greedy. When people are greedy, that's when we need to be fearful. So right now, people are greedy. These NVIDIA stocks and AMDs and all of these stocks are just high flying. Nobody is scared. So Warren Buffett would basically say this is not the time for you to be selling tons of premium, getting premium on options contracts simply because there's no fear there, right? When fear is high, that's when you sell options premium because it makes the options more expensive. But now it's very, very low. Okay. So VIX is our fear gauge. VIX is low now. So there's nobody afraid. So if nobody's afraid, Warren Buffett would say, be a little careful because everybody's being greedy. When everybody's greedy, that's when you need to be a little fearful. So we don't overdo it now by selling a lot of options. The more options we sell, the more theta that we have. So let's go back to our little list here. So VIX is 14 now. If VIX is less than 15, then I have a minimum theta of 0.10% and a maximum theta of 0.10%. Remember, on a $100,000 account, that would be a minimum theta of 100 and a maximum theta of 100 for $100,000. If VIX goes up between 15 and 20, I need to put more options to work. I need to put more trades to work. And then I could have a low VIX or a low theta of 100 to a theta of 200. If VIX gets between 20 and 30, put more money to work, more opportunity. You could sell up to $300 worth of theta. The more options you sell, the more theta you have in your account. If it gets between 30 and 40, I can have up to 0.40% theta, which means $400 for a $100,000 account. And if VIX gets above 40, that's when you say, hey, man, I could be at $500 worth of theta in a $100,000 account. And during the COVID crash of 2020, VIX got up to 81, I believe. Wow, what an opportunity. That's when you would have been selling options because the option swells. It becomes from the size of a golf ball to the size of a watermelon. That's when you sell those because the volatility makes the price of those options go up. Questions on theta? And you guys are not going to be options experts just going from this and doing this. I understand that. Let's go to the third thing that we look at, and this is the tachometer. I don't even know how you spell tachometer, but tachometer, maybe that's it, tachometer, shows how much you're revving up, right? And this is the amount of collateral that you have to put up to make your trades. So again, when VIX is high, that's when you put more of your buying power to work. You use more collateral in making your trades. Okay. When VIX is low, you don't put on as much buying power. So buying power ensures the portfolio's overall position sizing is not too large and the portfolio is not taking excessive risk. It is permissible to run the portfolio at 50% all the time. Now, I'll show you when I run it at 50%. But otherwise, go by this chart. So here's the chart. If VIX is less than 15, I should not be using more than 25% of my buying power. What does that look like? All right, so let's go to this account again. Here it is. And it says buying power usage is $262,000. Ladies and gentlemen, I am using 69% of my buying power in this account. Well, that may be a problem because I'm using too much. And this one I'm using 98%, and this one I'm using 103%. But I take the bill out of it. I don't consider bill as the collateral. And see here, I've only got 123 there. The capital of me putting up buying the bill. So I actually use just my options position. So instead of using 262,000, I'm actually using 139,000. 139,000 divided by whatever this account is, 370,000, that's going to be less than 50%. Okay. It's the amount of collateral that you have to put up to make your trades. That's what VIX is. And remember, And the higher VIX is, the more I can use. So if VIX is above 40, which it's not, I could use 50% of my buying power putting on trades. That means I would have more options trades on. I would be selling more premium. Now, there's a couple things that give me permission to go at 50% all the time. See, right now, VIX is less than 15, so I should be at 25. However, my plan right now is to use 50%. Why? Well, I use a couple of technical indicators to tell me if it is possible or permissible to run the portfolio at 50% collateral if the underlying price is above its 200 daily simple moving average. Remember, I trade the E-mini futures. Let's see what that looks like. So I go to a daily chart of the E-mini futures, and I put on what is called a 200-day moving average. This is a moving average. It takes the 200 prior days close, where it closes at, averages them together, and comes up with a nice little smooth line. So you can see whether the market is heading up or headed downward. And right now the market's heading up. It's above its 200-day moving average. It's the average of the last 200 closes. So I look to see if price, this is the current candle of where price is. So we're right at the 51.32. Is it above its 200 daily moving average? It sure is, which means I can use up to 50% of my buying power. All right. I also look at the 10-month moving average. So I changed my chart from a daily chart. This is the daily price. I change it to a monthly price. And this is the monthly. This is where it started at last month. In March, this is where it is now. And I look and see if price, which is 51.32, is above its 10-month moving average, means it's taken the closing of all 10 of the last months and made a moving average of what those is and keeps up with the line. Then I also can use up to 50% of my buying power. Then I also go to a weekly chart. And this is a weekly chart. So this is weekly price action. This is what it did last week. Here's what it's doing this week. Here's what it did the week before last, the week before last. And I look at the 10 exponential moving average. Now that sounds really fancy, but what that simply means is it gives more weight instead of weighing each of the 10 months previously equally. It takes more weight toward the most recent weeks and comes up with that average. So you can look up what an exponential average is. And I do the 10 weekly moving average and the 20 weekly moving average. As long as this 10 is above the 20, I am allowed to use 50% of my buying power. If, however, the 10 is below the 20, then I regress back to what the chart said. And the chart said, to do it this way, chart said to do it this, I would be at 25% buying power if the 10-week exponential moving average was below the 20. I would be at 25% buying power. Now, I have to go to my son's little concert. They've got a large group performance evaluation. So I'm going to leave you. But what I'm going to do is I'm going to post this trading plan as a resource in our Blackboard. So you'll have it. And then next week, what I want to do is, since I showed you what I track, delta, theta, and buying power, I'm going to show you how I actually do the trades next week. So it'll be really, really good. Y'all don't want to miss next week because this is a really good strategy. And what I found with this strategy, here's the great thing. This strategy over the last 2 years has done 24% one year. It did 20% last year. And so this entire strategy is up what, 44% over the last 2 years? Whereas the market, the S&P 500 was down 20% and then was up 24% last year. So the whole market is up plus 4%, right? Over the last 2 years. I am up 44%. The S&P 500 is up 4%. This is a really strong strategy. I've never seen anything like it. And I will go into the nuts and bolts of this next week so you'll know how to trade it. Who's got any questions? Jason, you got a question? Are you good?
I'm just curious, how much time do you put into this? Is this like a daily, you're plugged in like hardcore for a few hours, or like how much invested in this are you?
About 10 minutes a day.
10 minutes? Okay.
Yeah, about 10 minutes a day. You can do this 10 to 15 minutes and track your trade. Like I do a daily YouTube video every day where I trade this account. And really, I trade so many accounts. I've got, 5 or 6 accounts that I'm trading. So I trade one account once a week. So really, if you had one account, you could do this strategy that I'm doing, and you could do it once per week for about 10, 15 minutes a day, and one day a week. You wouldn't even have to look at it. I mean, you might just want to look at your positions just for the heck of it, just take a gander. But really, you could do this strategy at 10 minutes per week, not per day.
Mm-hmm. Okay.
Now, here's the problem, Jason, that most of the time, this strategy prints money. The trade, and you'll see next week, the trades that I put on have a greater than 90% probability of profit. Problem is, when the market does go down significantly, it tests us. And there are about 10 days per year that I found over the last couple of years to where you're like, oh my gosh, why am I even trading this strategy? It's too risky. You got to manage your risk for about 10 days a year and be on pins and needles. But the rest of the time, it's really, really easy. It just prints money.
Okay.
So we'll go over that next week, okay? And I will go ahead and post this so that you can start reading over it. And we'll talk about the Black Swan hedge, laddering, circuit breakers, all kind of things that we've got in here for risk management. But this is a very comprehensive plan. And it's kind of cool, right? I mean, y'all know how to make money. To make money, you put money in the S&P 500 and you do it over a long, consistent amount of time. If you want to diversify into international, that's fine. But really, putting it into ETFs and broader market ETFs is the way to go. This is just something that if you want to turbocharge your returns, I think you can do it. It does carry higher risk, though. Any other questions? All right. If not, I will see y'all next week. Y'all have a great day. Bye-bye.